Okay, so now we're continuing our discussion of the considerations of risk and material misstatement due to fraud as it relates to a financial statement audit. And up until this point in AUC Section 240, we've discussed or we've gone through how we should have discussions with our engagement team, with management, with those charged with governance. We also went through how we need to assess the risk of material misstatement due to fraud and identify risk factors thereon. And so now we get into the part where we need to respond to those risks that we found. And over the next several videos, we will go through how we should respond to those risks. And first, we'll discuss the overall responses. So this is the responses at the financial statement level. In the next video, maybe we'll go through the responses at the assertion level here. And then we'll go into a little more detail of our risk related to the management's overrider controls in a subsequent video. But for now, let's go through this AUC section 240.28 through 29. And this discusses how, in accordance with 330, which we'll have a video about later on, the auditor is supposed to determine overall responses to address the assessed risks of material misstatement due to fraud at the financial statement level. So these are risks that are pervasive across the entire financial statements and not necessarily at an individual account or disclosure or transaction class. And so to determine our overall responses to address those risks, we should assign and supervise personnel, take into account the knowledge, skill, and ability of those individuals. And we should give them more experienced or skilled individuals the task of assessing and responding to the risk and material misstatement due to fraud for the engagement, because they would be better able to assess those risks and respond to them appropriately. Also, we should evaluate whether the selection and application of accounting principles by the entity or accounting policies by the entity, particularly those related to subjective measurements and complex transactions, may be indicative of fraudulent financial reporting resulting from management's effort to manage earnings or bias that may create a material misstatement. And finally, we should incorporate an element of unpredictability in the selection of the nature, timing, and extent of the audit procedures. So in summary, when we're determining the overall responses to address the assessed risk of material misstatement due to fraud at the financial statement level, we need to select the appropriate engagement team members to take part in that determination. We need to hone in our responses to the more complex transactions or the ones that require subjective measurements, because those are more likely to have material misstatements, possibly due to fraud. And finally, we should incorporate some unpredictability into our procedures. That way, management can't really predict what procedures we're going to do, and then maybe fraudulently set up responses to our questions or fake documents to provide to us, or even to make transactions in the journal ledger be small enough to fall within our scope that we typically use. So we'll go through each of these in a little more detail in the explanatory material below, starting at A38, looks like through A42. So let's take a look at the explanatory material as it relates to the responses to assess risk of material misstatement due to fraud at the financial statement level. Okay, so now we're down in the explanatory material where we're discussing response to assess risk of material misstatement due to fraud at the overall financial statement level. And as we remember from the requirement, they had three things that we should do in our determination of the responses, and that was to assign appropriate personnel to review the accounting principles of complex transactions and to incorporate some unpredictability. So let's see what the explanatory material describes for us, for instance, for each of those instances. So say here that when we are determining our overall response to this risk of material misstatement due to fraud, we're basically reflecting an increased professional skepticism as it relates to the fraud. And in that vein, we're increasing our sensitivity in the selection of the nature and extent of documentation to be examined in support of material transactions. And we're increasing our recognition of the need to corroborate management explanations or representations concerning material matters. And in order to do these things, we need to first assign appropriate personnel and to supervise them appropriately. For instance, we might assign people who have specialized skills and knowledge related to the area that we're looking at, for instance, forensic and IT specialists, or we can assign more experienced individuals to the engagement. And also the extent of supervision reflects the auditor's assessment of risk of material misstatement due to fraud and the competencies of the engagement team members performing the work. So if we have a lot more experienced engagement team members who are performing the work, then maybe we don't need as close supervision. But if it's relatively new or less experienced engagement team members, maybe the more experienced engagement team members need to supervise them closer. Next, we have the accounting principles. As we saw in the requirements, we're required to hone in on the accounting policies of the more complex or subjectively determined accounts. And that's because management typically has a bias in the selection and the application of the accounting principles, such as those related to contingencies or fair value measurements, revenue recognition or accounting estimates, related party transactions, or other transactions without a clear business purpose. So we need to make sure that we hone in on these types of transactions and accounts whenever we are assessing, or rather we're determining our responses to the assessed risk of material misstatement due to fraud. And finally, we need to incorporate some unpredictability in our procedures and in our responses to that risk. And as we discussed before, the perpetrators of fraud at the entity might be better able to conceal their fraudulent activities if they know what we're going to be asking for or looking for. So we need to incorporate some unpredictability in there to make sure that they can't try to conceal their fraud in that way. And so we might can achieve that by performing substantive procedures on selected account balances and assertions that we don't usually test or that are immaterial or just not risky. We might also adjust the timing of audit procedures from that otherwise expected. So if we usually perform a test in March, June, and August of every year, we might switch it up this year and do April, July, and October or something like that. We might use different sampling methods. And finally, we might perform audit procedures at different locations or locations on an unannounced basis. So maybe there's a warehouse with inventory that we don't usually look at because it's immaterial, but maybe one year we decide to choose that one. And so that would incorporate an element of unpredictability. So in summary, all of these steps that we have gone through here will help us determine what responses we should make to address the assessed risk of material misstatement due to fraud at the financial statement level.